Stop paying someone else's mortgage when you could be building a property empire of your own instead. But here is the problem: most busy professionals in a job in the UK are sitting on 50,000 to £100,000 in savings, earning practically nothing in their bank account, while property investors are quietly building wealth that could fund their entire retirement. I learned this the hard way as an NHS doctor. Despite having a six-figure salary, I was terrified of property investment. The complexity, the time commitment, the fear of making expensive mistakes, it all felt overwhelming. But what if I told you there is a way to invest in property without ever visiting the city where you're buying your house, without dealing with estate agents, solicitors, or builders, and without spending your weekends viewing properties? Today, I'm sharing my conversation with Chris Graham, who has helped hundreds of professionals just like us build property portfolios completely hands free. We are going to break down exactly how his clients are generating £300 plus per month cash flow from a single property, why Liverpool is outperforming London for investors, and the shocking mistakes that cost first time property investors thousands of pounds. But here is what nobody tells you about property investment: the biggest barrier isn't lack of money, it's lack of time and knowledge. And by the end of this video, you will have a clear roadmap to overcome both. I am Dr. Suman, and if you are a busy professional in the UK who's been putting off property investment because it feels too complicated, this conversation will change everything. Let's dive in. Hi, Chris. Welcome to the channel. And thank you for joining me from your busy schedule. Tell me more about you, what you do, and how you can help people getting onto the property ladder as an investor.
Of course. My name is Chris Graham. I am the founder of JKG Property Group. So I help busy professionals, either corporate or business owners, get on the property ladder. The way I do this is I offer a completely hands-free business model. So for those busy professionals that don't have the time to invest in property, I will find properties, I will negotiate, get them agreed. I will take it through soliciting process, conveyancing. I can handle project managed refurbs and then hand it over to a letting agent. So I really get your money working hard for you.
Your message about successful professionals having the savings but not the time to invest in property really hits home for many of my viewers in the UK's Indian community. They have followed the path, having a good career, a job, some savings as well. But as you often say in your LinkedIn post as well, that an investment property still feels out of reach because we are very confident in going for maybe a stock market, which you can do with your phone very easily. But going out in the market, scouting for property, we don't feel comfortable. And even as an investor, I've been an investor for more than 10 years. I don't feel confident doing that. So let's start there. Beyond the obvious lack of time, what is the single biggest and perhaps the least obvious mistake you see that like usual job oriented professionals make when they first try to go to the property market alone? And what are the things that you often see?
In terms of mistakes, I think, like you said before, there's other avenues you can get into, like stocks and shares, etc. And it's relatively easy to get into, whereas property, it's very complex. It's a topic that's talked about a lot. There's a lot of strategies that people can employ, and it gets confusing pretty quickly. There's a lot out there on social media about all these fantastic strategies. People are talking about service accommodation, HMOs, buy to let. And I think that can often dissuade people from getting involved because they get information overload. And actually, when you can use someone like me, you can really simplify things, and you have that person there to walk you through everything. Whereas people try and go it alone. And you mentioned time before. Time is a massive thing. And when people don't have time, they tend to act in a way that has more risk and less patience. So they get involved with something where they don't know what they're getting involved with. And that comes with the knowledge piece. It's not taught in school. People don't teach the fundamentals of property. It's just talked about that it's a great way to park your money. So the biggest mistakes I see is people getting involved when they don't know. And it's mainly due to do with location and the properties that people buy. Now, the first thing people will do, they'll go on to Rightmove and they will start scrolling, looking for properties. They don't know what they're looking for. They'll speak to an estate agent that we've got to remember works on behalf of the seller, not the buyer. So it's in their best interest to get the best price for the seller. So they will say, I've got this amazing property. It's on the market here. It's a flat. It's 120,000. I think it's a really good deal, and someone will go, right, I'll take it. When actually that 120,000 could be not market value. It could be overinflated to get the best price for the seller. Is flats the right thing to buy? Do you know about flats? Do you know about the risks regarding flats? So I suppose the mistakes are endless, but it all boils down to two things. It's one, not having the knowledge to invest in property. And two, it's the time element that people rush things because they've built a career. They're probably very educated people. They're probably done very well in their own career. They're flying, they're doing really well. And they think, okay, if I get in property, surely I can get this right. And it's extremely easy to get it wrong. So they're the biggest mistakes I see.
Right. Yeah, I think that resonates well with me and hopefully with many of my viewers. And this is something that we want. This is the pain point for us. Like, if you want to go for property investing, this is probably our main pain point. So, your message about successful time poor professionals resonates deeply. Now, especially within, let's say, the Indian community or any the expat community in the UK, where there is a strong drive for financial security. Like, we have grown up in India, we know that if you're wealthy, you must have property. And this is probably true across the world. Like, I know China, people prefer real estate compared to the standard markets. So you say the main barrier isn't lack of funds, but a lack of time and the fear of the unknown. Could you start by breaking down the single biggest and perhaps the least obvious mistake you see these professionals make when they do try to invest the property in their own?
The big one I see is them getting involved with property but not knowing what comes after that, because when you get something accepted, that's only the start, right? You've got to understand what happens then, whether you're buying in cash or a mortgage. Do you know what a mortgage is? Do you have access to a mortgage broker that can get you the best possible deals, or are you going to talk to banks or maybe sorting out your own finance? Once you've done that, you then have to get the property into legals. You have to find a good solicitor. Unfortunately, the soliciting, the conveyancing process in the UK is so far behind where it should be. It's disorganized. It's too thorough. There's a lot of poor solicitors out there. So even just getting a property into legals with the wrong solicitor can be catastrophic. It can fall out of bed due to miscommunication. I've had numerous people come to me where they've had properties in legals for 6 months and they don't know where they're up to, and they don't understand the process that the solicitor goes through. And that's really important, that you know what is the first step, what is the second step. And if they're telling you that the inquiries haven't been answered, then you're pretty much right at the start and you've got a lengthy way to go. So that's a big one. And having that power team around me is crucial to be able to offer my service for potential clients. Once you've got that out of solicitors, you've got the keys in your hand. It's then looking at the property and thinking, really, okay, does this property need a refurbishment? And if it does, where do I start? Because, for instance, if you are in India investing in the UK, who do I choose? How do I manage it? When I'm with a builder, how do I organize it? How do I get scope of works documents? How do I make sure that I've chosen the right spec? How do I make sure that I check up on it weekly? When do I release payments, etc.? That is a minefield, and there's a lot of, you hear the term rogue traders in terms of builders. There are a lot of bad ones out there that have walked away with people's money because they say, okay, it's a £30,000 project, give me £30,000 now up front. No, absolutely not. But that 9 times out of 10, people will give it. They'll not finish the project and then they'll run off with the money. So you don't have to do a refurb, but if you do, there's that element of risk there. And then once you've done the refurb and you've got the property, it's then who manages it. So are you going to self-manage? Probably not if you're abroad. How do you find a letting agent that really cares about your property, wants to put a paying tenant in there, wants to make sure that that tenant is screened, is interviewed, they're putting them in based on not only their records, their financial records, but also in terms of character as well. That you want your letting agent to sit down with that person and gauge, is this person going to look after this property? Is it a family that's going to be in there for 10 years? Or is it Joe Bloggs off the street that is just into a job? He doesn't have security in a job, and 6 months later, you're trying to get him out of the property. So just getting from offer accepted through to income is a long road, and it can take a lot of time. So it's having the people around you to be able to get you to that point where you're getting paid rent.
Right. So you describe your service as entirely hands-free, which sounds like the perfect solution, but can also feel a bit abstract. Let's make it tangible. Could you walk us through a real-world case study, maybe your last client and the case that you had? For example, let's say an IT consultant who lives in Reading or London, or a doctor in Birmingham becomes your client. Now, what are the exact steps from the initial investment to them receiving their first rental income? Like the process, what does it look like? And crucially, what are the checks and balances you have in place to ensure their investment is protected at every stage of this process?
Sure, absolutely. I can talk to you about my most recent project. So I have 2 clients, in fact, working together in the same limited company. 2 Dutch guys that one lives in London, one lives in Netherlands, and they had some money put aside where they wanted to start investing in property. So from the start, what I will do is I'll have a 15-minute sort of call with a client just to gauge how serious they are, if they want to move forward. We'll discuss sort of the capital that they have access to, because that's important. If they're saying they've got £5,000, it's going to be very difficult to get into property. So there's a lot of sort of screening questions that go into that call. Then if I feel we can move forward and it's someone I want to work with as well, because that's very important, you have to have a good relationship. These are clients that I want for years to come. We go on to a strategy call, and the strategy call really aligns the client's goals with the type of property that we buy. So I focus purely on buy to let. It can be buy to let with a refurb, buy to let without a refurb. So these clients really wanted to grow their portfolio quickly. So we had to find a strategy where they could pay for a house, but be able to pull some equity back out quite soon. And that's what we call a buy, refurbish, refinance project. So you buy it low, you refurb, drive the value of the house up, and then you refinance and pull some equity back out the deal. So we agreed to do that. The client will sign my terms and conditions. And as part of that terms and conditions, there's a box that says agreed criteria. In that box, that's the agreed criteria. So 2 or 3 bed terrace. So in this case, it was a 3-bed terrace. They told us purchase price that they could go up to, depending on the capital they had access to. It has to be a freehold property. It has to be a house, not a flat, because I don't condone purchasing flats in the UK. And it had to be a property where you could add value to. From then on, they pay a small commitment fee. And what that does is it really gives commitment that we're going to work on this together. I go out and look for properties. This one I found was the second deal I presented to them. So I get the offer accepted. I have another Zoom call with them. I'll run through the deal with them. And when you talked about the sort of ins and outs of the deals, I'll go through real detail. So I'll go through the financials, so what returns they can expect. I'll go through the area in terms of its crime rate. Does it have highly rated Ofsted schools? These two are big things. If it's got low crime rate and really good schools, it shows that it's a really good area and that you're going to get great tenants. We'll also look at the refurbishment. So I will send my builder in to do an estimate, which is standard practice in the industry, which involves him going in, looking at what works need to be done, putting a price against it based on broken down into literally each room. So when I'm presenting the deal to them, I'm going through all this information. And then I will look at the area in terms of comparables for that property once it's been refurbished. So we know the purchase price, but we need to know how much it's going to be after the refurbishment. And that's key because that determines how much equity they can pull out. It gives details like the EPC rating, little things like if there's an EPC rating of an F, for instance, you can't mortgage it. So that is a really important thing to look at. So it's those little intricacies that someone that's not invested in property might not see. I'll organise the finance for them, give them an idea of things like how much the mortgage is going to be, etc. But this is presented in a pack. And then all the potential investor needs to do is say yes. So in this case, on the second property, they said yes. We then hit go with the agent, get it into legals, and then from there, I instruct my solicitors. If it's a off-market deal where we found it direct to vendor, we can have two of my solicitors acting on behalf of the vendor and one acting on behalf of the buyer. And that's really effective because you can get it through legals quicker because you're seeing both sides of the story. But in this instance, it was an agent deal. So the agent instructed the seller's solicitor and I instructed the solicitor for the buyer's solicitor. We then got that through legals, and we are just now at the back end of a £31,000 refurbishment. And what that looks like is just prior to going into refurbishment, I will give them a breakdown, a scope of works for each bedroom. So in bedroom 1, is the flooring getting replaced? The boiler that's in there, is that getting replaced? Does the house need a full rewire? And that should align with the estimate that I give them at the start. But it's broken down into room to say, this is what my builder's going to do in each room. We agree that. It goes into refurbishment, and then all I'm doing is sending them weekly updates on the refurbishment based on the payment schedule and what we've agreed. So, for instance, rip out stage, and then first fix electrics and first fix plumbing, then another payment's released. So once those works have been done, I'll do a tour around the property with the builder. If I'm happy it's been completed, I'll send the walk round video to the clients and then say, please, can you pay this bill for that lot of works? So when I discussed earlier about not releasing all the payments, we strategically do it so we're only paying for what's been completed. Because we're working with a builder that is reputable and has cash in the bank to be able to pay his trades. So we're just paying him once the work's been done. So we're right at the end of the refurbishment now, and I'm now speaking to the solicitors about getting a mortgage valuer out to give us an indication of what the end value will be. And that bit is crucial because that's where they can pull their equity out. So we're right at the end of that process. And at the same time as doing that, I'm in contact with the letting agent that is another member of my power team, where we're going to get a tenant in as soon as that refurbishment's done so they can start cash flowing and getting rental income.
Right.
That's sort of my hands-free process. There's a lot of people, like you say before, that look at that hands-free and think, is it completely hands-free? I would say it's not completely hands-free because there's certain elements of things that they need to do. So yes, you need to review the terms and conditions and sign and agree. Yes, you need to review some bits of paperwork for the solicitor because there's an element of your own due diligence as well. And I make sure that when I'm talking to the solicitor that you have your say at the right time, and there's certain information you should be aware of. So there is elements throughout the conveyancing process where you need to agree to a document. And yes, when I send you an update video to say, are you happy to release the payment? Yes, you've got to release the payment to the builder. So it's not completely sit back on a chair and watch it, but it's very minimal amounts of work in relation to the work that I am doing in exchange for my fee.
Right. So technically, they don't have to visit Liverpool at all.
No, a client from London has not visited, and they don't intend to visit.
Okay. So many of my audience are based around the UK, and particularly people living in London or in the southeast part, they feel priced out of the market because they have gone up so much. Now you are based in Liverpool. Liverpool, I live close to Liverpool. I love the city of Liverpool. Like I spend a lot of years in Royal Liverpool hospitals training, as well as all the hospitals in Liverpool. Now, for an investor who has never even visited Liverpool, can you explain why you believe that they should choose Liverpool rather than London? And what are the specific economics and demographic drivers that that gives you confidence in Liverpool for the next 10, 20 years?
Yeah. So a lot of investors actually get excited about London, and the reason they do is because if you have the cash available to invest in London, you can benefit from capital appreciation because it does go up in value, but it doesn't have the increases that somewhere like Liverpool does. And I'll come back to that in a minute. But if you spend 1 million in London on a house, say, if it increases by 2% year on year, your capital appreciation is larger in Liverpool. But in Liverpool, you're getting more for your money. Whereas in Liverpool, for £1 million, you could get a hell of a lot of properties and a lot of cash flow. So I would only condone someone to invest in London that has an astronomical amount of capital that they can just drop into the property and just let it sit. And those are the types of people that are high net worth that literally just give their money and let it sit, because there's also a challenge of people that have too much money and they need to get rid of it. So for super high net worth individuals, London is a great place. Let me come on to Liverpool now. So we spoke about that capital appreciation element before. If you look at Savills predictions, which is generally on point, the Northwest region is going to be the fastest growing region for capital appreciation in the next 5 years, which is 29% growth. London is actually at the bottom of that pile. But the example I gave before is those high net worth investors know they're getting a large cash value, even though the capital appreciation percentage is so low because they're putting more money into it. But for people that have worked hard in their career, they maybe own a business where they've got a pot of cash, say 100, 200,000 pounds. Liverpool is perfect. You will speak to a lot of people, a lot of property investors that all say my area is the best, but when you actually look at the facts, the Northwest is due to increase the most over the next 5 years. Fact. And you asked about what that's down to. I think it's down to that. First of all, people have started getting excited by Liverpool, so they've started buying more. When there's more demand on an area, the prices rise. So that's one thing. And the second thing is the regeneration element. If you look at the amount of money that they're putting into Liverpool, the waterfront project is just astronomical amounts of money. And generally, when you see regeneration in an area, property prices increase because it brings in jobs, it changes the landscape. People want to live there, so it brings in owner occupiers as well. So it's a mix of those two things. I think it's the excitement around Liverpool that just keeps getting more exciting, and the regeneration in the area.
Right. So let's talk numbers now. Now, because this is where the people get stuck. For someone watching who has diligently saved, say, 50 to 6,000 pounds for an investment, what does a typical deal with your group looks like? Could you break down the finances of a recent project, purchase price, refurbishment cost, fees, and most importantly, the expected monthly yield that they can expect?
Yeah. So I've got a sheet on my second screen here just because it's a lot of numbers to read out and I wouldn't have been able to remember it all. But my bread and butter with my clients is small refurbs, buying really well, good purchase price, small refurbs. The reason small refurbs is because they can cash flow quicker. So it's getting through this listing process, getting the keys in the hand, small refurb really quickly onto the rental market, cash flowing really quickly, and that's really important. So if we go back to one of my recent deals, so I always recommend less than 125,000 purchase for someone that's got that much cash. The reason being is because of stamp duty. So the threshold for a second investment property is 125,000. So you would pay 5% stamp. For overseas, it's a surcharge of 2%. So you'd pay about 7%. For any UK buyers, it would be 5%. So if the last one was £120,000 purchase, okay, so the good thing about property is you can leverage using a mortgage. So you don't have to raise all of that cash. You can use a mortgage. So on that £120,000, you're looking at a 25% deposit. So that's £30,000. You've got some buying costs, and you spoke about mistakes before. A lot of people miss these off. They think what they're buying the property for is the end. It's not. So you've got your conveyancing. So that's your solicitor that you need to pay for, 1,800. You've got a mortgage broker that I pay 500. You've got a survey. A survey is crucial. You should always get a survey done, and that will be a RICS valuer, a speciality trained RICS valuer that will go into the property and make sure that there's no subsidence, there's nothing you haven't seen on the viewing, roof, all these really expensive things that potentially are avoiding you going into a deal which could collapse because of the property. So the survey, £500. You've got your stamp duty, which I spoke about before. So 5% would be £6,000. You've got my fee. So on that £120,000 property, you've got buying and stamp costs of 13,800. A refurb, it was about 3,000. So we just did a quick refresh, things like carpets, redecoration. And what we're trying to do when we refurb a buy to let is we want to do just enough to get the ceiling rent of that street. So if, for instance, we buy it and it'll probably get 750, but we know that we can get 875 on that street, we'll do just enough to get the 875. With a buy to let, there's no point throwing another 15,000 with an all singing, all dancing kitchen. There's just no need for it. It needs to be functional for a family that works and it looks good. On that, you get around 850 rent. So just to break down in summary, total cash needed. So that is your £30,000 deposit. It's your total buying and stamp costs that I said before, 13,800, and your refurb of 3,000. So that comes to £46,800. So you mentioned someone's got 50 to 75. I always recommend a minimum of 50 that work with me for that reason. It's gonna cash flow £307 per month, and that is net cash flow. So that's in your bank. So to get that figure, you need your rental income, which is your 850 a month. You need to take away your building insurance. So that's like fire, lightning, explosion, subsidence, anything like that. It covers everything. You've got your management that you need to pay the letting agent of £85, which is generally around 10% of your rental income. And we also put some money aside for maintenance. So around 5% a month, just so if, I don't know, a shower in 8 months' time breaks down, you've got that pot of cash aside. You're not putting it anywhere, you're just keeping it, you're holding it. So that's your 850, take away those costs I just mentioned to get your and your mortgage payment of 375 equals your 30750, which is profit in the bank at the end of the month. That is about 3,600 quid per annum, which a return just off your cash flow is 8%. Now, anyone that puts their money in the bank, it's a lot less than that, and that's one of the attractive things about property, that it's steady and it's probably triple what you'd get in the bank. Another thing that's not mentioned that I also put on my analyses is the capital appreciation element, because over time houses go up in value. So at the moment, I mentioned in 5 years it would grow 29%, which is over 5%, but I put a conservative 5% growth rate in. So you're looking at 8% just with cash flow, plus another 6% with capital appreciation. So you're talking about a combined return of 13% on your 46,000 spent. So good solid investment.
Makes sense now. So finally, for the professional watching this video who feels this is the solution they have been looking for, but is still hesitant to take the first step, what is the smallest, safest action they can take today, this week, to move from being a passive saver to an active property investor? And beyond working with group like yours, what is your number one advice for building a property portfolio that truly provides freedom rather than becoming a stressful second job?
Okay. So the first I would say is get a little bit of knowledge. I would say make sure that you can sit on a call and you can understand that the person knows what they're talking about. I think I would also I would thoroughly recommend getting someone like me that's doing all this for you. Things to check for is previous projects. Get them to send you a previous project, pictures, numbers, put them onto a previous client. So who is your last client? Call them up and say, hey, Mr. Client, what was Chris like? Make sure they're compliant. So there's a lot of sources out there that are not compliant. So there's certain things like insurances you need. You need to be part of like a property redress scheme, an ombudsman. So if you need to make a complaint about me, I need to be part of the ombudsman. So all these little compliance checks are really important. So yeah, all those things, just really do your due diligence on the person and have a little bit of the knowledge to know what you're talking about. In terms of your second question, I would thoroughly recommend getting involved with buy to let to start with and buy to let with small refurb. What it'll do is, one, I promote it anyway. It'll get you onto the market, find you a great property, sit back, watch the rental income come in, and watch your wealth grow hands free. Once you've done that, then you can look at all the other strategies. Then you can have a look at what does serviced accommodation look like, what does HMO look like. I don't touch any of them personally, so I believe in buy to let. It's solid, it's predictable, it's been around for 50 years. The other strategies are relatively new and heavily compliance driven. HMOs, you need fire alarms, you need other compliance, fire doors. The regulations are just through the roof. You've got Article 4 direction where you can't get change of use. There's loads to think about. So buy to let, it's really basic. It's been around for ages. It's proven. So I would recommend thoroughly the person looks to do that first with someone like me, making sure that they do their due diligence. I get the hesitancy. It's a lot of money to spend on property, and you've worked your whole life for that pot of cash. So you really want it to work well. I think there's an element of people who do well in the corporate ladder. There's an element of not taking risk because it's based on decisions and it's based on facts, and it's really difficult to change your mindset between being that conservative person to I'm going to put all this money into property that I've worked my whole life for. So it is a big risk, but just reduce that risk by finding out about the person you're working with and get a little bit of knowledge so that you know you can challenge them if they're telling you something.
Thank you. I think this will solve a lot of questions that people have who are sitting with a cash pot but not getting the confidence enough to proceed, and maybe the analysis paralysis that's stopping them from getting into property investment. Thank you for explaining that so well, Chris.
No problem at all. No problem at all.
Friends, that was Chris Graham. If you have any questions, please do let me know in the comment section below. And if you're part of my WhatsApp community as an NRI investor, then feel free to DM me if you have any burning questions. Also, I have put the link to their website in the description box below. Please do visit the website to know more about how to get started with your real estate investment, particularly in Liverpool. Please don't forget to hit the like and subscribe button if you want to see more and more videos like this. This is Dr. Suman helping you build your wealth one step at a time. See you in the next video.